whatever we do, we want to be sure it's legal, we want to be sure it's ethical, and we want to be sure it's moral. If it doesn't pass those three tests, we are not going to present that to a client. And if a client is pushing on something that is not legal and ethical, we are going to make our recommendation. And there have been instances where we have withdrawn from an engagement because we do not see what the client is requesting, checking the box on all of those three mantras.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Michael Uadiale. Michael, how are you doing today?
I am very well. It's good to be on your show, and thank you for hosting me.
Yeah, absolutely. Well, appreciate you joining me. Michael is a seasoned CPA master tax advisor with over 25 years of industry experience, including 18 years running SMEED CPA as the founder of a seven-figure revenue firm with 15 employees. He's developed proven systems that really help entrepreneurs achieve financial freedom. And that's done through some strategic tax planning and wealth building. So I think everybody that's listening here, wants to help increase their wealth. And they definitely want strategic tax planning because that's a big hit on our income. So Michael, with that said, give our listeners a bit more about your background and we'll dive in.
Thank you, Todd. Again, I'm first of all an entrepreneur before being a CPA. So I always like to start with that distinction just because I get the feeling that a lot of entrepreneurs get frustrated with our profession because they feel like we are constantly being roadblocks to what they desire to do. Because the one thing I found, entrepreneurs want to do what they want to do. And I say I'm an entrepreneur, so I get it. I happen to be one who has 6 successful running businesses, and I find taxes as a strong leverage to accelerating that journey to financial freedom. Just like you said, I have co-founded SMEED CPA with my spouse. The company is 18 years. We've done some very amazing things legally, ethically, and morally in helping clients reduce their taxes. We continue to do that. That's our passion. And the dad, the granddad, I play around with my kids, do rough houses over the weekends and stuff like that. And that's who I am.
Love it. Love it. Well, thanks for that. So let's dive right in. Let's talk about, how people can, maybe eliminate some taxes. So let's talk about that. You have a 6-step system to slash your tax bill. And obviously one of the biggest things that I think everybody wants to make sure they do is whatever they do, they don't want an audit, and they don't definitely, if they somehow get an audit, they definitely don't want to be in trouble. So let's talk about the six-step system.
Yeah. So the DECIDE, which is our 6-step process, is an acronym. D stands for deduction. E stands for entities. The C stands for credit. The I stands for income shifting. The D stands for debts. And then the E stands for elimination. Those are our 6 proprietary steps that we use to legally and ethically help entrepreneurs get on the journey to zero taxes. You just talked about an audit. Now, I don't think entrepreneurs should be so afraid of an audit. Nobody wants to go stand in front of a moving 18-wheeler truck, right? So being reckless is not what we are advocating. The tax code is a tool. It should not be a trap.
Yeah.
And that's where working with tax advisors who truly take the pains to educate, understand, and be able to really be abreast with what the tax code says, how the tax courts are interpreting the code, and how the IRS is interpreting the code. Those are very important things because those are the things that the entrepreneurs need to trust their advisors to know. Unfortunately, there's this belief, and I'll come to what this ECID really means. Most entrepreneurs think the Internal Revenue Service is the highest authority when it comes to taxes. The answer is not. They are not the highest authority. The highest authority, first of all, is the United States Constitution. And in implementing that Constitution, the Supreme Court comes first, all right? Followed by the appeals court, followed by the tax court. The reason why I bring this up is the IRS can give guidance. They can give their own interpretations. They can come up with regulations. But most of the time, when you look into tax controversies, you're going to find where people take opposing interpretations from what the IRS interpretations are. And there are many instances where taxpayers have been successful. So that's where people must be very careful. And I think that's where the frustration with my profession comes, because many people in our profession just seems to always want to tell the entrepreneurs no. Okay. Yeah. So I'm just framing the mindset here. So typically, I always say to clients, when I guide or when our practice, we guide clients, we want to, for example, go into the Blue Book. The Blue Book really is not the Kelly Blue Book, by the way. The Blue Book is what the CPAs and the tax attorneys who are on staff with the Joint Taxation Committee, which is the committee of the Senate and the House of Reps, who come up with the tax laws. When those laws are passed, you will realize that anytime a law is passed, even to the very last minute when that law is being signed, changes are being made depending on the political negotiation. All right?
Yep.
This last OBBBA is a good example. It was signed into law July 4th. Up to that morning, there were changes that were still being made before the president signed them into law. Having signed it into law, it is now the responsibility of the CPAs and the tax attorneys who are on staff with the Joint Taxation Committee to come up with what is known as a Blue Book. The Blue Book really gives examples and those CPAs and the attorneys' interpretation of what the politicians have written, how they should be implemented. And I'm saying all of this because people need to see beyond just the Internal Revenue Service. That's a big piece. Now, as we speak, this is August here. The law came into being July 4th. There are lots of things in these new tax provisions for which the Internal Revenue Service may not have guidance, implementation guidance until next year. Okay? So people should not just take what they see in the Internal Revenue Service website or publication as the be-it-all. My point is there are a whole lot of interaction of components of authorities, and you must be able to determine where in that hierarchy of authority the Internal Revenue Service publications fit into. And I don't want to go into all of those details, but it's so important for people to know that. That's why for us, we see the tax code as a tool and not a trap. Okay. Now, coming to our proprietary system, it's simple. I mean, we just use that same thing over and over, and it works, okay? Because for us, one of our mantra is whatever we do, we want to be sure it's legal, we want to be sure it's ethical, and we want to be sure it's moral. If it doesn't pass those three tests, we are not going to present that to a client. And if a client is pushing on something that is not legal and ethical, we are going to make our recommendation. And there have been instances where we have withdrawn from an engagement because we do not see what the client is requesting, checking the box on all of those three mantra. Okay.
Sure.
So for us, the first thing is the D, which is deductions. Now, that's what most people focus on, all right? But so we see it as first base. Just being able to use all that Section 162 of the tax code says to your best advantage. Because again, taxes are incentives that the government puts in place to direct how they want entrepreneurs to behave and where they want entrepreneurs to drive capital into.
Yeah.
What I mean by that, you are a good real estate investor. Now, why has real estate been so popular over the entire generation? It's because many times people who are good in real estate investing, they see the tremendous tax benefits in addition to whatever their motivation in going there. And the government has deliberately designed it that way because the government doesn't want to take on the job of being responsible to be building houses for its citizens.
Yeah.
So the only way to drive capital in that direction is to give people the incentive to do it. So deductions are important. Deductions are pretty much saying, okay, what does this tax code say? And for me, when I'm looking at deduction, it has to follow my acronym of BOND, right? The B stands for, it has to have a business purpose. It has to be ordinary, meaning it is typical in nature in relation to that industry or business. It has to be necessary. Necessary mean has been defined by the tax code to mean that it's something that can either one help that business grow or help it to increase its market share. And then the D stands for documentation. So the first thing, that's what our first D stands for, deduction. Now, when you've been able to look at a client's profile and you have been able to take every available deduction that that client needs to be taking that he or she may not know about, then you can check that box and we move to the next one, which is E. E stands for entities. Again, typical for real estate folks. How do you all do business? Typically, you are forming LLCs that are filing taxes as partnership. And when even at the partnership level, you begin to have a general partner, limited partners. And there's a reason for all of that. I love partnership because partnership laws really allow you to do a whole lot of things, for example, that you may not be able to do with S Corp or C corporations. Okay? Yeah, because you and I can be partners in a partnership. You could bring in all of the capital, and I am bringing in only the sweat equity.
Yeah.
And we can structure that thing and say, okay, I'm bringing the sweat equity. I am the general partner. You are the limited partner.
Yeah.
In partnership, we have what we call special allocation, Section 4704B of the code. So partnership, for example, allows you to do all kinds of magic in a legal way, right?
Yep.
So E stands for entities. I mean, I just, before I came on this podcast, I was looking at a prospect's tax return where she's grossing over 2 million, close to 3 million. But guess what? She's still doing business as a sole proprietor. What is that doing to her? Yeah, that's creating for her self-employment taxes that she could have avoided if she had had a good tax advisor in the past, and that tax advisor have just said, look, change how you do business. So
just by making that little change,
yeah,
how much money can she save just by making that little change?
Excellent question. In her 2023 returns, because she has not done her 2024 return. In fact, she's supposed to be doing business with one of our existing clients, and then the client of ours asked to see her tax return and saw what was going on and said, you need to go see these guys. Just by making that change, she will be saving, no kidding, over 68,000 in taxes. Yeah, because her self-employment tax is killing her, but she doesn't know that, right? So entities matter. For me, I always say to clients, entities are the pillars that helps to build that house. that
Yeah.
you try to build. Okay. So how you run a business is important. Now, unfortunately, because LSs are very important, popular, people tend to just go in there. Well, it's not a one cap fits all. I
Yep.
mean, for example, with this new OBB bill, all right, the government has really turbocharged Section 1202 of the code that will make C corporations become viable for people who that may be a great fit. What I'm trying to say is that every entity type is good, but you want to make sure you are optimizing your tax strategy, making sure your entity type aligns well with the type of business you are doing, with the goal you have in mind, with your exit strategy when you're getting off your business. So there are just a whole lot of things that's going to drive what you choose to be your entity structure. So that's what the second acronym E stands for. Okay.
Yeah.
The next one is credits. I love credits so much because credits, they are in most cases about 4 times more powerful than deductions. Because what are credits? Credits really is the government literally paying your tax bill, literally subsidizing your tax bill. With deductions, which was our first D, yeah, you get in. So let's just use a very simple example. If you choose to go buy a car of 100,000, right?
Mm-hmm.
Because you're trying to reduce your taxes. What has that done for you? What it has done, assuming you are in a 37% tax bracket, is, well, that car that cost you 100,000, you've been able to deduct that 100,000, it saves you 37,000 in taxes.
Yep.
But when it comes to credit, credit is a dollar for dollar write-off on your taxes, meaning, yeah, you could be ending up with a tax bill of 60,000, but if you have the appropriate credits that is relevant to your kind of business, those credits will literally make your tax bill to disappear. So that's why we call it a dollar for dollar write-off on taxes, right?
Give me
There
some
are,
examples of credits. I'm trying to process
so
what that is.
let's just even use a very popular one that was overly abused and until the government clamped down on it, employee retention credits.
Oh, sure.
That's a credit. There's small business health insurance credit. There are all kinds of even with this new bill, there's still the clean vehicle credit. There's alternative fuel vehicle refueling credit and there's employer provided child credit, right? There is advanced manufacturing production credit. All of these things really there are thousands of credits, to be honest.
Yeah.
So thousands of them. So that's why when we work with clients, we don't work with people who want to just do tax returns. We work with clients on a 12-month engagement because we take the time to really look at the industry that particular client is and figure out, are there any credits, for example, when we get to that third stage, that may be applicable to that client, that the clients most likely may not be taking. So credits are very, very powerful. They are extremely powerful. So there's just this tendency to just overlook many of those credits, right? But like I said, there are lots of credits that are out there for different business type, depending on the industry. Because again, taxation is all about the government wanting to incentivize behavior. So what did they do? The last administration wanted to incentivize the green energy bill, right? So they loaded up a lot of credits in that direction.
Yep.
But this new administration is focused on making America great again and then manufacturing and all of that. So if you see what they've done in this OBBBA bill, the idea is to encourage capital to go in the direction that the government wants. So credit is something that you should never ignore. The fourth thing, which is the idea, that is what we call income shifting, okay? Income shifting could be magical also, because when you look at many taxpayers, Only in very few instances do you have situations where a taxpayer is just on an island all by themselves. A taxpayer could be married, they could have kids, they could have parents, they could have grandparents, they could have relations that you are not seeing on their tax return. Now, if a client is already at that highest marginal tax rate, a good tax advisor should begin to make those inquiries to ask and say, who are those people within your sphere of influence that you may already be supporting one way or the other?
Mm-hmm.
Okay. And begin to say, are there ways legally and ethically to restructure, right, your taxes such that some of those income are legally shifted to some of those people that are in low tax bracket? Simple example, very simple, basic, simplistic. You have a child that is 14 years old, right? Your child is not earning income. He or she is a dependent on you. But so because he or she is not earning any income, they are at a zero income. There are ways you can shift some of those income to a child so that instead of you paying all of your taxes at that highest tax bracket of, say, 37%, you can shift some of those income to the kid. And now the kid has some income. The government, in my opinion, is literally subsidizing you raising your child because that child now is earning income that is taxed at a lower level than you are.
Yep.
I have worked with clients where they can leverage that and be able to save collectively the family anywhere from 10 to 40% basis point in taxes. Now, some people listening to me will say, well, there is the kiddies tax. Yes, but there are other tools. That is where the E we talked about is important, entities.
Yep.
There are things like you can set up trusts. There are what is known as grantor trust or non-grantor trust that allows you to shift some of those income from yourself to a trust that is in the name of your child or your grandparent or parent. So all of these are things that good entrepreneurs and investors who are truly, truly wanting to get to that zero tax bracket that people are desirous to get to, they need to sit down with a good tax advisor and talk through. That's why we don't work with people who want to just do tax returns. That's not our game. Okay?
Yep.
Because one of the ways to manage your taxes is that your income shifting, being able to shift income from a high bracket person within your sphere of influence to somebody in a lower sphere of in a lower bracket, it's tremendous. So again, there are ways these things can be done legally and ethically. You're not hiding anything. When it comes to taxes, we don't want to gamble. I started this podcast by saying nobody wants to stand in front of an 18-wheeler. I'm going through a client's audit that is a large business. It's a think maybe one of the biggest caviar manufacturing business in the country. And there are so many things the IRS is throwing at us, but we've been working through all of their requests and providing them what they want. So you want to do things in a way that you can go to sleep as a tax advisor and
Right.
same thing as the client. Okay, so that's the I. The next one, which is the D, that is step number 5. I call that debt or leverage. Okay. In fact, before we got on this podcast, I just got my marketing team to post on our Facebook page today, and I said, bonus depreciation is good debt minus taxes. That's what 100% bonus depreciation is about. So if people are wondering, why is there this so much excitement about bonus depreciation that is bad? What has the government done? The government is saying, go do leverage. Do leverage. It's not your money, but by reason of the leverage, you are taking all the tax benefit. Yes, the bank or the financier is getting interest income. I get that. But if you put a 20 or 25% down on the real estate, for example, and the bank is financing 75% or 80% of that portfolio with funds from people who don't know what to do with it or who are afraid of good leverage. I always say to people, if you are afraid of leverage, then you don't trust the assets.
Hmm.
Okay.
Good point. Yeah.
Yeah, because if you trust the assets, then you know that asset. Because what is an asset? An asset is something you are investing that is supposed to generate income
Yeah.
to pay for the liability that you created by reason of the leverage.
I mean, you got to
So
be smart with it, right? But
yeah, yeah.
yes, yeah.
So yeah, but that's the point. The bottom line for me is if you don't trust the asset, don't leverage.
Then don't
If you
leverage
are
it. Then don't
concerned,
buy it.
yeah. If you are concerned about, I don't want to owe, why would you do real estate if you
Yeah.
don't want to owe? So do your due diligence on the asset and leverage. The government allows you to do that leverage. I mean,
Yeah.
because imagine now you own 100%, but it's not your money that went into 100%, but you get 100% of the tax benefit. The
Yeah.
bank is not getting that tax benefit. The bank is getting interest income
Mm.
that's ordinary income to them. So
Mm.
that's my fifth step, which is the D for debt. So leverage is a very important thing. I mean, I'm not talking of going to borrow money or using money from a credit card to go on vacation to Cancun. That's just complete. Do that,
Yeah.
okay?
Yeah.
So
You
that's
can't
the
write that off
difference.
either.
Yeah, exactly. So because when people come to me and they start saying, "Well, I don't want to," oh, the first thing I'm asking is, "Okay, can we define what we're talking about here, right?" Because if you do your due diligence well, then that asset should be good. Don't go and put money into an asset because of taxes.
Yeah.
Because for us, what we do is we want the client to be able to say, this is how I make my money. And our job is to build the wealth strategy around that. I mean, the tax strategy around that wealth. Okay. And then the last point there is the E, which is elimination. Now, this is my favorite because it's not free, but really, there are people who don't want to pay taxes. It's philosophical for them, right? They like, I don't want to give a dime of my money. All right, you do you. Our job is to find those strategies that are legal, they are ethical, they are moral, that allow such people to be able to eliminate their taxes. Okay.
Mm.
And what has bonus depreciation done? Bonus depreciation has just turbocharged
Yeah.
a lot of those kind of strategies
Yeah.
because of the 100% bonus depreciation. Okay. So now, for example, there are strategies that we have where somebody could be putting in $30,000 into a strategy. They get a basis of 300,000 in an asset because of bonus depreciation. They be able to write off that asset of
Yeah.
$300,000 this year. That's like, okay, at 37% tax bracket, that's about $111,000, right? Now, yes, you've put $30,000 into that strategy, but that investor is ahead by over 88,000 in savings. You see, what the government did with this new tax bill is not about reducing taxes for the sake of it. I get it. There's all this noise on the media. I'm not there. I'm a professional. I'm not a politician. What the government did with this new bill was they created pathways for people to be able to save in taxes significantly. And the expectation is that when you save in taxes, you take that savings and you reinvest it into something, either in your
Right.
business, additional portfolio, or something. That's what the government did here. And that's why I'm kind of like on the hill, screaming on the mountaintop and saying to everybody, hey, you got to begin to talk with your CPA now, not to wait until the end of the year and you find, oh, I could have done or I should have. So there is just a whole lot that the government threw into this bill that can really supercharge our last step there, which is E, which stands for elimination of taxes.
Yeah.
And I
It's
gave you a long answer.
all these things that you just mentioned. I mean, the government puts them in place. It's not so you can avoid paying something you're obligated to pay. It's not that that's the reason. It's the reason is so that the economy is better, that there's more jobs created. They're incentivizing you to do the things that they want done. I mean, simple deduction for kids, like they want people to have kids. So they're going to give you a deduction if you have kids, right? They want people to go build businesses. So they're going to give you deductions to go build businesses, to buy real estate, to create jobs. Like they want you to do these things, go do them, and then you'll get rewarded.
Exactly. So my mentor always says to change your taxes, change your facts. I mean, you nailed it, Todd. The government is saying, go do these things.
Yeah.
And so when people are coming to us and they are wanting to reduce their taxes, the first question we are asking is, how do you make your money? Right? Because how you make your money greatly impacts, right, how you can use the tax code to leverage your financial freedom. I always say to my real estate investor clients, I need you to figure how to make sure you have some of your real estate portfolio in the places you love to travel to for vacation.
Hmm.
Because I want you to be able to go on those vacations and be able to legally repurpose legally what would otherwise have been non-deductible business expense as business travel expenses.
Yep.
You should be investing in it. If you love to be going to Hawaii so often and you go there 3, 4 times a year, how about you have something in Hawaii that allows the airfare and some other of your expenses on that trip to become a deductible business
Yeah.
expense?
Absolutely. Hmm. Makes a lot of sense. Maybe I should go buy some places in some beautiful places I like to visit.
Yeah, you should look at that.
um, how you mentioned the big beautiful bill.
Yeah.
How does that specifically, like, most of my investors are real estate investors, or sorry,
Mhm.
most of my listeners are real estate investors, and also business owners too. But how does that affect people today, and what should people really be thinking of? Is there anything really exciting about that kind of bill that you think entrepreneurs need to be really thinking about?
Yeah. The answer is yes. I think it has never been better. In fact, I did a webinar August 7th on the big beautiful bill.
Hmm.
And I titled that webinar Cash In Now with the largest tax bill in US history. I mean, really. And I'm not talking about, what is supposed to be the deficit created by the bill.
Yeah.
I'm talking about the benefits to individual investors, whether real estate or business owners. Now, we already mentioned that briefly. I think the 100% bonus depreciation, it's a game changer. Okay.
And it doesn't go away. It's not like the last time.
Exactly. Right.
Yeah.
So the last time it was staggered. So it was kind of going down by 20% every year through to 2025, where it
Yep.
was supposed to end up at 20%. But what have they done? They have said effective January 2025, it's permanently set at
Yeah.
100%. In my webinar, I use real life client examples, not mentioning their names and stuff like that. But let's use a real estate investor. I have a client, he's a property manager, and they were going to owe, there are four of them, they were going to owe collectively maybe about 180,000. And I know they had the cash, and I said, why not consider buying a property this year,
Yeah.
2025? Okay. And then 2 weeks after that, they came back to me and said, yeah, we found an office building. We would like to buy it. We want to put in an offer for it for 1.5 million. All right. So we ran through the numbers. I can tell you, one, for a 1.5 million property, they were going to put in about 300,000. By reason of them doing the cost segregation on that building, literally, every of the monies they will put in as their down payment, right? They were going to get that money back in tax savings this year. So I said to the client, you are literally going to be buying this building at zero down
Yeah. Yeah.
by
I mean,
reason of
That's an amazing deal. So instead, you're saying instead of paying taxes, so the money they were going to pay to the government, instead,
Exactly.
they used that money to buy an asset that is now going to likely make them money. Hopefully, they bought it right. And so it'll make them money. So they were either going to give the government 300 grand or they could just buy this office building.
Yeah. So the thing I found in my over 18 years as a practicing CPA is the ultra wealthy, they don't take their tax bill on the face value. They are very strategic
Hmm.
on every financial decision they are taking to ensure that it's well optimized for taxes. So that what the tax bill becomes, it's not an accident. Okay. I have clients, they will be discussing with me today triggers they want to pull in 2026 and 2027. And the whole idea of those conversations is to begin to say, how best do we structure these things so that one is consistent with the tax code, is consistent with what they want to achieve. See, the problem comes where there's not this constant interaction between taxpayers or entrepreneurs and their tax advisors. That's why we don't work with people who are only interested in, hey, I want to prepare my tax return. I'm like, that's medicine after death. Preparing your tax return when the year is over, that's anybody can do that.
Yeah.
Thank God for AI. Next 2, 3 years, hey,
Hmm.
if CPAs are there looking to be preparing tax return January to April, you know what? AI is going to do those things beautiful well. I mean,
Yeah.
Intuit has proven it. So
Well,
if that's what you are anchoring your business on, that's a losing game.
yeah. There's a good point. Not to sidetrack it, but when you think about AI and technology, CPAs, the ones that aren't doing strategic planning like you, like there's not a need for them, right?
No,
And eventually here, there's just I would think that there's going to be a profession that's called a tax preparer, and it literally that person is barely getting paid. They don't need to get paid a lot, and because they're plugging things into AI and not doing much, and
yeah,
and
I
that's
mean,
a entry level job as a tax preparer, and the
exactly.
CPA that's left is going to be the strategic CPA that's working with their clients from the beginning of the year to the end of the year, figuring out how can we be strategic with the money that's being made.
And the good thing with AI is the fact that even in doing this strategic work, right? Now, you can use AI to query tax court cases, to query IRS notice, to
Hmm.
do a lot of things. I mean, there were times before AI where I could just spend a whole Saturday, because I typically like to do those kind of research on the weekend when I'm not having calls or emails and all of that.
Sure.
I could just spend a whole Saturday finding a relevant tax court case to a situation that I'm working on. I don't do that no more,
Hmm.
right? I use my AI tool to say, hey, here are the facts of this situation. Can you find me tax court cases that support the position that I'm trying to take here?
Hmm.
And then the AI tool gives me that in like 15 to 30 seconds. It's
Yeah.
not my job to go read those tax court cases, right? And then look at the fact of the case, see what the judge said, see what the IRS position is. I still have to read that. I get that. But now I'm not like looking for a pin in a haystack. I
Yeah.
got all the pins. My job is to say which of them fits my fact pattern.
Yeah.
So, I mean, AI is going to be
Hmm.
so transformative to our profession. So, when I'm seeing people who are like, oh, well, I don't want to touch AI, I'm like, are you kidding me?
Yeah.
Seriously?
Yeah. It's amazing what it can do. It's transformative. Yeah. What do you think is there like a entrepreneurs, again, most of the listeners are real estate investors, but is there like a big miss that a lot of people, make when they're thinking about their tax strategy?
Uh, I wouldn't use the word big miss. I will use the word common miss. And that has to do with how you can really leverage depreciation for your portfolio of real estate. Meaning, and I think you know this, there's what is called a real estate professional,
Yeah.
right?
Yeah.
Okay. We work with a lot of physicians, dentists, and those kind of high wage earners, licensed practitioners who like to do those kind of things. Many of them, when they come to us, because this has been so ingrained in them that there's no way for them to qualify as a real estate professional, they miss out
Hmm.
on all of the benefits that could accrue to them, right? I'll just give you an example. I think on Friday last week, my last meeting was a dentist in Boston. And he just bought, I think he bought his second building with his partner. They get ready to buy a third one. And they were saying, well, we were told that there's nothing we can do about bonus depreciation and stuff like that. So I'm
Yeah.
like, hey, boss, let's zoom out of the situation. And I pulled out his entity map. Now, when we looked at all of his structures, he has a dental practice. Okay. So if I'm going to tell you in a short answer what that big miss is people miss how to match income types. What I mean by that is Internal Revenue Service classifies income into 4 buckets. All right. There's active income. So when you are a W-2 wage earner, all of that is active income.
Yep.
Now, if you are a business owner, all of that is ordinary income. The difference between the ordinary income and the business income is the fact that one of them suffers Social Security and Medicare, the business is not suffering that. Then you have what is called your portfolio income, right? And then you have your capital gains. Now, there's what we call the PAS versus the PIGs, meaning passive income generators versus passive activity losses. And the reason why this is very important to your real estate listeners is the fact that when you look at a taxpayer, there are ways to structure and figure how to be able to take what would otherwise have been passive losses that you cannot use and change them to either become active losses or structure them in the way where they now have passive income that
Hmm.
matches those passive losses. So I call it the pigs versus the PAS. So I would say that's the common big miss that most people miss in real estate.
Yeah.
There's just this tunnel vision on how they approach income. But and that's why it's so magical to talk about entities. Because again, let's say you have a business owner. The business owner has 2 kids. He or she doesn't have any other passive income. But that same business owner has real estate, right? If you structure and pass some of your shares in that business that is making money into your kids' trusts, that is passive income for the
Hmm.
kids.
Oh, wow.
And then you come and you take
Hmm.
your portfolio of real estate, right? And you re-engineer the partnership in a way that, again, that was at the beginning, we talked about the partnership rules, right? Special allocation. So you take part of that partnership, it takes some of those income that will not, losses that you as the real business owner could not have deducted. It's matched against the passive income in the kids' trust.
Wow.
You've just created magic in a legal and ethical way.
Hmm. That's amazing. That's
So,
amazing.
so that would be, in my opinion, the common big miss I see more commonly with most real estate investors.
Yeah,
Yeah,
sure.
because all most CPAs are telling you is Oh, because you make over 150,000, you and your spouse, for example, by reason of that, of course, your real estate activities by default per se is passive. Okay, I get that. So if my real estate is passive, how do I find passive income?
Yep.
Okay, assuming I can't find a pathway to becoming a real estate professional. Hope that answers that question.
Yeah, that's awesome. Michael, this has been great so far, man. There's a lot here. Obviously, anybody interested in learning more about how to reduce taxes should probably be reaching out to you. How can our listeners get in touch with you?
Uh, we have so many ways to reach out to us, but I just say when I'm on podcast, because I do a podcast at least once every other day, I say they should just get in touch with us through a simple email address. That is taxes, T as in Tom, A as in Apple, X as in Zeros, E as in Edward, S as in Sam. Taxes at SMEEDCPA.com. S as in Sam, M as in Michael, double E as in Edward, D as in David, C as in Charlie, P as in Paul, A as in Apple.com. So that's an easy way because that email address is monitored by my assistant and they take a look at what's there and
Yeah,
they go from there. That would be the
that's,
easiest way to reach us.
that's great. All right, I want to switch gears a little bit. What's a favorite book you can recommend to our listeners? It can be about taxes. It can be about something totally different.
What was the question?
Favorite book you can recommend?
Uh, who? Not about, I think I do a lot of reading. Let me put that out there. I think the book that I just recently read that has been impactful to me as a business owner and entrepreneur is Amp It Up, AMP, Amp It Up by Frank Slootman. The last name is S as in Sam, Lootman, Amp It Up.
Love
It's
it.
been a very transformative book for me as an entrepreneur because he gives four creed or guideposts that should lead any high performing entrepreneur.
Love it. Love it. Haven't heard that one, so I appreciate a new book. I get a lot of the same books, so I like hearing new books. All right. Last question. What are your three pillars of wealth creation?
Ooh. My three pillars of wealth creation is one, operating a business, two, reducing taxes, and three, be very well insured. Insurance is a great way to pass on generational wealth tax-free.
Yeah, love those. Love those definitely. Um, so business, you got to create the wealth. Taxes, you got to keep the wealth, and insure. Well, there's another one. You gotta make sure you don't lose it. So love it. Michael, again, really appreciate you being on the show. Appreciate your time. A lot of good information, and listeners reach out to him. You have a fantastic rest of the day.
You to have a great week also.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work
work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.